Good morning. Today, we have a special guest on the pod, Captain Jack Barrow. So, if you guys don't know, Berachain launched very recently, and it was huge. It was probably the most anticipated launch of the past few whiles, and then it happened, and there have been mixed reviews, let's say. But I think there's a lot that's misunderstood. Like what actually is live, what isn't live yet, what's coming down the road, what you can actually do on Berachain. And so that's why we decided to have a Berachain expert come in today and hopefully dispel some of the myths and explain some of the stuff still going on. So, Captain, thanks for joining us. Can you tell a little bit about like sort of your role in the Berachain universe?
Yeah, thank you guys for having me on. I'm Jack, or Captain Jack. I am DeFi Bear at Berachain. DeFi Bear in practice ends up serving a lot of different roles. I work with the DeFi teams on mechanism design, give product feedback, tokenomics, all that kind of classic stuff, as well as some business development work that you'd expect from a DeFi person. Also do kind of like a lot of strategy and special project stuff, and so designing Boyco was something I spent a lot of time on, as well as executing it, building kind of theses in terms of, from an ecosystem perspective, what are narratives that we want to have exposure to, what are the applications that kind of are benefiting from those narratives, and like who's executing on them most effectively, and then taking opinionated positions on stuff like, when we were first getting set up for Boyco 6 months ago almost, we had to kind of decide what assets do we really want to focus on. And one of the opinionated bets there we made was on Bitcoin LSTs. And, 6 months ago, they were just really starting to get off the ground properly. Babylon, I don't think, had even done their first staking cap yet. And so at the time, that was a pretty opinionated decision. I think it's one that's held up pretty well in hindsight, but there's a lot of those kind of decisions that you end up making on a daily basis. And I am one of the bears that helps make them.
So you're probably pretty in the trenches in terms of DeFi then, sort of what protocols are existing, what they're doing, where they are in development, and how they're going to sort of participate in that sort of broader narrative that you're trying to facilitate.
Yeah, exactly. So I would think of like from a DeFi perspective, but even from a general app perspective, because at this point, and this has been something I've been saying for almost 2 years now, is DeFi as we think of it and know it, which is like you and I going to farm yield on someone's front end, is one version of DeFi that will continue for a while and maybe will always continue in some capacity. But there's also like this more realistic version as the industry matures, which is like DeFi as this thing that underpins every application in some capacity, right? It's like if I have a swap mechanism on my gaming front end or my consumer application, that's DeFi on the back end. If they have a savings product to allow someone like Starbucks to build like a yielding product for the cash that they have in the Starbucks app, right? Which is like what every company wants to replicate. That will be DeFi on the back end in some capacity. And so having also kind of like structured and opinionated bets on how that gets realized is, I think, something that's also really important for like long-tailed ecosystem success. But then you also need to pair it against the fact that like Starbucks doesn't want to do that on crypto today, right? And so if that's like your goal and your mindset, you're probably not going to live to see it unless you also have these really thoughtful, opinionated bets on the builders and consumers of crypto products that are here today, right? And so trying to walk that tightrope is I think like a really important part of the job.
So before I dive into the Berachain ecosystem and sort of what the flow has looked like for DeFi users on Berachain, I want to give a chance to Patrick or Mara to ask you any principal questions.
Yeah, I'm gonna meet you, Captain Jack. Big fan of Berachain and excited to dive deep into everything you have going on. But I also am just curious to kind of like start at the Boyco level. It was a pretty big decision that you guys made using this new system, right, for bidding for liquidity. So I'm just curious kind of like, about the process that you guys went through in deciding that you wanted to use Boyco and why it ended up kind of being a powerful primitive for you guys. And then also just like any lessons learned. It feels like you guys may have started a trend here. It seems like there's already going to be other, kind of layer ones and other blockchains that other like L2s and stuff like that may want to use this. And if there's any advice that you can give them. I know there was this kind of whole issue around like hybrid and third-party vaults, also major vaults, and there was kind of a lot of at least confusion around that. So any lessons learned would be super interesting to hear.
For sure. So this originally started, I got on a call with Jay way back when at this point, back when I first joined Berachain, and he was, pitching me on using Boyco for the chain. And I was, I thought it was interesting, but in some capacity, it's a little redundant to proof of liquidity, candidly, right? There's probably a way to make it overlap, but I couldn't see it right off the top of my head. And I had been at Polygon prior, right? And one of the things I had spent a lot of time working on at Polygon specifically was the ag layer, which is like the cross-chain interop platform. And specifically, I'd done some work building out kind of like dev tooling for it. And we spent a lot of time working on like what we called bridge and call functionality, which is this idea of like bridging from chain A to chain B and then calling a smart contract on chain B. And in doing so, you're able to abstract away a lot of different functionality, right? Like that's not a complicated idea. It's something that like folks like Jumper and Stargate have embedded in their bridge functionality. But it is like a really important unlock from a design space perspective that I don't think a lot of people are using. And that's basically the majority of what's under the hood here, right? Is we built this product called the CCDM with Boyco. And the way you can kind of think about it is it's Boyco as the front end on chain A, which in this case is Ethereum, this cross-chain deposit module under the hood, which basically just does like a bridge and call type execution. And then it deposits into the application on Berachain. Where that gets slightly more complicated is in this universe of, the chain isn't actually live when you begin this project yet. And so you actually have to come up with like a good way of facilitating that call on the other side, the contract call. And so the way we ended up doing that was through this group called Enzo, which is probably like one of the better teams that no one actually knows the name of. But they built a lot of intense platforms under the hood. They built this thing called the Wayroll wallet that a lot of DeFi applications use under the hood. And so we ended up integrating with them, and they helped out on a lot of the scripting work for the deposit recipes. In terms of lessons, a lot, a fucking lot. Like if I was going to do this again, there would definitely be a lot of things I would have done slightly differently. I think that's like a natural side effect of any time you kind of take a massive leap into the unknown and try and do something. All right, thanks. And try and do something completely different than what other people have kind of done in the past. And, net, like relative to how other people have done these sorts of vault bootstrapping chain style products, I think like this is still significantly better than anything we've seen in the past. There's still some TVL waiting to come online since I see you guys scrolling. The Veda and Concrete Vault assets, which is the EtherFi, the Lombard, and the Athena asset should be online kind of the next 24-ish hours here. So expect to see another big jump in DeFi TVL then. But in terms of like things that I think I would be more thoughtful about, one of the things that I wasn't really expecting was the pre-deposit vaults, right? Like I built this entire campaign around Boyco as the end in itself. And then once the pre-deposit vaults went online, I think we were somewhat like candidly caught off guard as to how quickly they took in TVL. And that forced last minute changes in some capacity, right? Because we had certain outcomes that we definitely wanted to achieve around like major liquidity on the chain, around ratios of certain assets. And, if we had gone the route of doing, of not including this bucketing system that I think ended up confusing a lot of people, you would have ended up with a universe where if there was kind of like one pair, like let's say the SUSDE USDC pair, SUSDE USDE pair was so intensely lucrative under the design because there was like a missed multiplier, you would end up having like 80% of the TVL funnel into that pair and functionally render like everything else you were trying to achieve useless. And so I think there's definitely space to kind of like improve on the design of the incentive distribution. But it's one of those things where, with you're expecting to launch on like Jan 14th, and then the first pre-deposit vault goes live from a third party on December 25th, and you kind of like have all this shit that you're doing for launch, and then you look one day and you're like, oh my God, we have $2 billion of TVL in these vaults. Like, How do I make sure that this can, because this was like something really important that I spent a lot of time thinking about was not just how do I get enough liquidity into the major assets that I care about, but how do I actually service sufficient yield on $2.5 to $3 billion of TVL? That was actually something I spent a lot of time thinking about and modeling and trying to break down. And I think we got there. It depends a lot on, I guess, where bearer price is on unlock, and that'll determine it. But I think one of the points of pushback that a lot of people had was that like the third-party vaults got diluted. That was a point I flagged to folks like 3 days into the pre deposits, was like, hey guys, this might be dilutionary. You should probably chill out a little bit. And then on top of that, though, it's also, when you have a major asset, it's both like higher utility in aggregate for the ecosystem. It's also higher kind of hurdle rate, and there's no underlying incentives on it from an asset issuer. And so I think by design, those pools should always be higher yield and service less TVL. Versus, if you're depositing into one of these like Key-N LST paired against LST pairs where you have like 5 to 8 levels of underlying yield from asset issuers, like I don't see it as Berachain's job in that universe to give like a massive amount of incremental emissions on top of that. It's really just about like, how do I clear the hurdle rate that folks that are holding that asset now would expect to have elsewhere in DeFi, right? That was kind of always the mindset. The mindset wasn't like, how do I ensure that every asset gets at least 20% APY? Like that was never the goal.
And I think we saw some posts about this actually, where I forget who did the write-up. I think it might have been you who was saying these are our expected hurdle rates for these different assets. Now, like, how can we achieve that? What does that look like with these like current percentages? Whatever was 0.9 going to bucket 1, and I mean, so let's talk about, was that achieved, right? If you look at the IYs for some of these assets, we see currently on stablecoins 17% here, 13% here, which is kind of crazy for SUSD. And then for Bitcoin, 12%. Now, if you can find anywhere else that has fixed rate Bitcoin for 12%.
That's what I'm saying, man. I feel like we hit our numbers. I feel pretty okay with them. Yeah.
I mean, and for ETH, we have Berachain at 9%. There's also an arbitrage play there for repeggers. Liquid Bear ETH at 8%, and this was at 13%. Earlier, actually, no, it was like 16% when it first launched. So I'm curious curious to ask how well you think you guys did in terms of hitting those benchmarks.
It's something I'm going to spend a lot of time on this week. Yeah. It's one of those things where it's going to be variable for a few reasons. The first is obviously Bera, right? Like you get your yield on unlock, and so there's still time to be seen there. In terms of like at a baseline, I was benchmarking these same things based off of the PTs, and from what I was seeing, it looks like we were pretty close to that. I think for some of them, we might have wanted to end up slightly higher. Like I think, if we had seen some of like the Liquid Bear ETH and Bear Stones up towards like that 11% mark as well, I would have been a little bit happier, but it's hard to complain about kind of like 2% there when you're working entirely off of like a model that you built in Google Sheets from like as like a solo actor prior to this thing launching. And so, I think in terms of the hurdle rate numbers, I think we got there. I think we nailed the major numbers. I think we got exactly the amount of kind of like TVL that we were expecting in that category, more or less. And overall, I think it's quite solid. I think a lot of the folks that were frustrated were folks that kind of like saw the pre-deposit vaults coming out and swapped other assets into those assets solely to deploy immediately. And as a result, like they saw it as, I deployed USDC into this, not whatever third-party asset, and they may have not actually strictly wanted to hold that. And so I think that might be where some of the frustration is coming from. But, I think in terms of hurdles, we got there. And the other thing I think that's probably not priced in here almost at all, actually, is the application yields and any kind of like underlying yield that was relevant there as well, right? And that I think this is basically like just Bera plus Athena sats, or Bera plus Solve incentives, or Bera plus Lombard diamonds, or whatever it was, right? Because I actually don't think that most people really knew or wanted to figure out how to price those things.
It definitely gets super complicated trying to price. Some of these assets I think have at least 5, some maybe even have 10 different kind of points with all sorts of different multipliers, and a lot of variables go into that. Congratulations, right? You guys have launched day one with a massive amount of TVL. It's pretty groundbreaking, honestly. Like, having a chain that launches and has what is it, $3 billion in TVL, kind of like right out the gate, especially once those Concrete and Lombard vaults get counted in. So that's great. I know that there's a ton of people who are now kind of like diving into the ecosystem, trying to better understand how they can interact with what's going on. You guys have created a pretty interesting system. There's this like 3 token system, right? There's Honey, which is like the native stablecoin. There's Bera, which probably people are relatively familiar with as being the gas token, or the kind of like main token of the chain, although it does have some different attributes compared to other kind of equivalents. And then there's BGT. Would you mind just like running through those 3 tokens for us and just kind of like talking about the use and the thought behind each of those tokens and how they kind of interplay into the system?
Yeah, for sure. So I'll start with Honey. It's probably the simplest and least relevant for kind of the core mechanism at this point. In the original Berachain design, like way back when, like Olympus governance forums type days, it was a like partially fractionally algorithmic stablecoin. Think like heavily inspired by what Frax was doing at the time. And obviously over time, I think the mindset and kind of product scene in DeFi trended away from those sorts of designs. And so we naturally did the same on our side, just because you don't want any existential algo stable risk at the center of your blockchain. It's just not a good idea. And so Honey at this point is actually really simple. It's basically just a wrapper for collateralized stables. Think like USDC and PYUSD right now. Over time, that basket will expand. I don't think it's something that will be ever like meaningfully risk taking. In fact, like my personal opinion is that it should be about the most risk off asset imaginable, and potentially only even use like highly centralized stables like USDC at all, just because there is this kind of unfortunate reality where adding anything to the Honey basket is an opinionated bet that if any of the underlying DPEGs, like if you were like UST is awesome, right? Like let's add that to the basket. UST disappears, and guess what? You've now DPEG'd a stable on your entire chain and ruined a bunch of DeFi, right? And so I think the opinionation here stems from a desire to like focus on maximal risk off at the protocol level, right? In terms of like what the Berachain Foundation is like really underwriting from a risk perspective in some capacity. BGT and Bera are, I think, this really interesting design that is really like the core of proof of liquidity. And Bera is the gas and the stake token, and BGT you can think of as kind of like the fee generating component of Berachain. And that fee generation stems from proof of liquidity itself, right? And we'll probably dive into that, I think, in a little bit more depth. But really at the end of the day, you can think of this as like in a standard proof of stake chain, the main token of the network is trying to do a lot of things at once for a lot of different people. It's trying to be a gas token. It's trying to be a stake token. It's trying to figure out some form of value accrual for folks that want value accrual in like the ultrasound money universe. It's trying to service like all of these different use cases simultaneously. And as you see in almost everything, if you try and do a lot of things at once, you end up kind of doing not all of them very well. And so instead, right, you're probably better off like actually separating out these functionalities into 2 tokens, right? This is actually something you see all the time in DeFi now. Think about all of the different DeFi models that separate out into 2 token models, right? Think like FraxETH, SFraxETH, PyRexETH, SPyRexETH, all the different USD, like Athena, USDE, SUSDE. What are they actually doing there, right? They're identifying 2 different use cases. They're identifying this use case of liquidity, which is the wrapped asset of like the USDE or the ETH stablecoin, so to speak, right? And then there's the second use case, which is like the savings and yield version, right? And by having the savings and yield component get minted in effect every time someone opts into the asset, regardless of what form they hold, but only certain people claiming it, which is the folks holding the yielding version of it, you actually create this better effect because folks that want one version of it can get one version of it, and that actually gives a more positive economic outcome for the other group as well.
So let's talk about the Bear Eco, because there's a lot going on and there's a lot that hasn't happened yet. And I want to sort of explain this part. So you just talked about proof of liquidity a little bit. My daughter's coming in here. Can you explain sort of what the flow is for a user who wants to participate in Berachain, and then what it means to participate in proof of liquidity sort of as a secondary portion there?
Yeah, absolutely. So let's maybe even take a step back and talk about like how proof of liquidity kind of works, because I think some people might be softly familiar, some people might not be. Proof of liquidity is basically, at its simplest, this idea of taking a standard proof of stake network design and just pointing the block rewards to somewhere else, right? And so for a lot of folks that are really familiar with DeFi, you can kind of think of it as like a Curve or Velodrome or Aerodrome style product. But rather than the incentive asset being in like the protocol's token, which actually isn't critical to the functionality of the protocol, right? Like Curve will run with or without CRV. We instead use this token that would already exist and be emitted in a proof of stake blockchain, which is the chain's gas token. And then by default, those go to application liquidity pools. Applications basically bid in their native token or whatever incentive that they want for those block rewards. And as a result, you actually get value capture that doesn't exist in any other proof of stake system, right? Because you have kind of the same kind of idea of inflation is going out somewhere, right? You're actually agnostic as to where that is, you net it out. And then validators get some amount of value recaptured, right? And that amount of validator value recapture is actually based off of demand on the application side. And so if there's a lot more block rewards coming out than there is demand for network security in effect, applications might only bid 50 cents on the dollar for those block rewards, get more efficient spend, right? Because they're getting twice the incentives that they are paying for incentives, which helps them scale more quickly. And validators are getting both like the base block reward, which is like that 16% of total block emissions, plus that 50% back, right? And so validators are still in effect getting paid through this system.
So would it be, I mean, this sounds similar to VE tokenomics, where there is some application that wants incentives and they bid for the block rewards. Is that true?
Yep, exactly right. Yeah.
And in doing so, maybe they're bidding, $1 or $2 for $4 worth of incentives, and then they return, like I think that the thesis on Berachain on a lot of these dApps is that they return a lot of that value to the protocol users. So I know like Dolomite, for example, or Bolomite for Berachain, they're going to have it be the case that you can have proof of liquidity participating collateral. So like not only would you have your collateral on here, maybe it's eBTC, maybe it's ETH, maybe it's Honey, like majors, right? Your stable coins, your Bitcoins, and your Ethereum, and their associated derivatives. Not only getting the yield that maybe eBTC would get, or not only getting the yield that, let's say, Pump BTC Bera RS ETH would be getting, but some additional yield from this proof of liquidity. Now, are there any like even vaguest estimates as what that additional yield might look like?
It depends on kind of a steady state, but I'll give you an example of like how you can kind of think about the math. In the early days, it will probably be pretty disgusting in some capacity, and I mean that as positively as possible, right? And so if I think about like if you have a bunch of links open, right? So jump over to hub.berachain.com for me quickly.
Okay, hub.berachain.com. I will. You gave me a link.
I dropped a link in the chat for you already. Yeah. Yes. And then go ahead and jump over to the vault section here for me. I think it's that one, if I remember correctly. Yeah. So you see right here, total circulating BGT, 732,000, right? That means total to date in the past 5 days since Berachain launched, there have been 732,000 BGT emitted. If I think about this from like a standard VE perspective, right? For a normal VE token, you want to actually get to positive unit economics because you have to justify exogenous emissions.
That's like $4 million of emissions, or almost $5 million. No, yeah, like four.
Yep. That's $4 million of emissions, exactly right. And then where it gets interesting though, right, is like within a VE model, if you think you can get $500,000 in bribes a week, which is probably not unreasonable, especially even in the short term, right? Like I'm not even talking about a scale, right? $500,000 of bribes a week. And let's say bribes turn on in 3 days. It won't be true, but like just to make our math easy. And at that point, there's 1 million circulating BGT. You're now generating $500,000 a week in cash flows to $1 million, to 1 million tokens, right? That's pretty insane ROI if you want to be the annualizer, right? And as a result, right, that yield profile to BGT will be insane. And the inherent spread of BGT to Bera will actually kind of like blow the fuck out. Right now, if you look at IBGT, it's trading at like 1.5 to 2x Bera. In reality, a lot of that will be variable based off of the bribes situation on like an ongoing basis, right?
So,
and what I kind of
my next question is going to be, why is it trading at such a premium? But I'll let you get there naturally.
Yeah, so it should trade, I think like that 1.5x premium is like, if you think about it from a bearer perspective, the only way to get access to these yields is to have BGT, right? And there's 2 ways in effect that you can get BGT at this point. The first is you can get BGT by providing liquidity into proof of liquidity, which is like the core design. And there's also like this workaround, which is like I can potentially use a liquid wrapper for it. But in a situation where a liquid wrapper is in high demand, it will trade at a massive implied premium. And if that if Bera, you can get the Bera staking yield, which is, maybe like 7-8% right now, and that's only because only a small portion of the network is staked, and that will go up over time, which will drop Bera yield down. And your other option has like whatever 500% APY in the short term. The number of people that are going to want the 500% APY option, especially given that it's sustainably driven, right? It's not just driven off of like some random short-term incentive stuff, is going to be really high. And that will kind of cause that IBGT spread to expand. And then obviously as like the amount of BGT in circulation start to normalize relative to bribes, that's when like yields will start to compress a little bit, and that multiple will kind of compress down. It should never be negative, as you can always burn IBGT back to Bera once they turn that on. And so, end result is you kind of get like to a little bit of a steady state where I think BGT is both like a volatility accelerator as well as a dampener in some capacity. Because if you think about what happens in a bull market, the amount of bribes, so to speak, flowing to BGT will increase. The circulation of BGT won't increase at the same rate. And so as a result, you'll get like this increasing yield profile, which increases demand for BGT, which then causes more liquidity to flow into the chain because people want to farm it, as that spread will increase. And then if you think about what happens in the downside situation, right, it's like, okay, I have the bribes will be decreasing, and the BGT will kind of still be increasing from an inflation perspective, but like at a fixed rate effectively, and that will be going down over time. And so what happens is that yield on BGT compresses, the incentive to hold it decreases, people start burning BGT for Bera. That actually reduces the number of claims on the yield in exchange for realizing inflation. And then as the number of claims on the yield decreases, you start to normalize rates again. And that normalization of rates, again, then re-incentivizes liquidity provision on the chain. And so while the way I would think about Bera is like it will have greater volatility within a range, but in exchange, you actually get like some volatility dampening in some capacity on the downside, in that like once you hit a certain amount of BGT burned, the system actually has a mechanism for recovery because that incentivization of liquidity is back once again. And it isn't solely dependent on something like the token's price recovering. And then the second order effect is like to the upside, right? In these positive market environments, you're actually going to see like an acceleration of liquidity because of this.
So you said so much, and so much has happened. Let's take it down to like a 5-year-old level and then build back up. So let's scaffold a bit. You have IBGT, right? IBGT is, as you said, the liquid wrapped version of BGT. BGT is non-transferable. So BGT is kind of like a reward that can be redeemed for 1 Bera. So it can be redeemed for real value, but it inherently is non-transferable itself. Now, IBGT is a liquid wrapped version of that. There are a few things happening here. One, there's staking of IBGT. So IBGT is not interest-bearing itself. It is simply the liquid version of a BGT, which is, again, should be valued roughly close to 1 Bera. But there's premium here because you can't buy a BGT. They're non-transferable. So the only way you can buy them now is through this liquid version. If you stake your iBGT, you get this APR of 776%. Now, question here, and I'm sure a lot of people are wondering this because they're so used to proof-of-stake chains, and this is a little bit novel, can you take your Bera and stake it for that APR, or is it only for BGT stakers?
It's only for BGT stakers. So the way to think about it is staking BGT is what allows you to participate in the upside from proof of liquidity itself. There is some small nuance to that in that staking Bera allows you to participate in the validator revenue portion, right? And so right now that 10% is basically the 1.6% base spread across only like 20% of the total stake in the network, right? And so as more and more stake comes online over the next week, that number will steadily decrease down. And if 100% of the network was staked, it would be 1.6%. The asterisk there is that validators also have a commission rate on the proof of liquidity flow. And so let's do a super simple example. Let's say an application bribes $1 for $1 of BGT, just to make it as easy as possible, right? An application bribes $1. The validator has a 10% commission rate, and 90% of that dollar flows through to BGT stakers in that validator. And so there's basically two forms of stake within every validator. There's Bera stake, which is like the true stake, and then there's BGT, which we call delegation, but staking is the term that most people are familiar with. And so folks that stake BGT within that validator get to participate in that 90% of non-commission bribes that has gone to that validator. On the other hand, right, from that 10%, a validator could choose to share that with their stake. And so in a universe where a validator has kind of like a moderate amount of stake, but a lot of BGT delegated, and as such is taking in a lot of commissions and sharing them with stakers, you could actually end up in an environment where, again, your staking number is also significantly higher than the base POS yield because of this rev share component.
Super interesting. I just also want to take us back a quick second, Steven, if you don't just mind going to the hub.berachain and then going over to pools. I hadn't quite zeroed in on the fact that there's a lot of emissions that are going out to LPs right now. So I think a lot of folks maybe are just like looking at Kodiak, looking at these different LP positions. Can you just like break us down exactly what we're seeing here? So for example, if I'm looking at the wrapped Bera Honey LP on this dashboard, this is just is this the concentrated liquidity position on Kodiak, which has then got like $27 million of TVL. It's getting, swap APR of about 26-27%. And then it's also, in addition, getting BGT APR of about 140%. Is that right?
Which is actually lower, because if you can mint iBGT against BGT at a premium, let's say it's 2x premium, that BGT APR should actually be doubled. Am I wrong about that, or is that correct?
No, you're 100% correct. And
Nice.
so that's why if you go to the infrared site specifically, you'll see that the rates are higher. And you're close but slightly off, Mara. So when you're looking at the pools on this hub page, these are actually the BEX pools, right? And you can kind of think of proof of liquidity having two phases. The first phase is where we're in right now, which is phase one, which is distribution. And so the idea here is the only pools that are available for BGT for a validator to set are these 5 pools. They can choose their ratio of emissions to these different pools, but for now, these are the only pools that effectively have been pre-approved by governance. And so these live on BEX. And the reason for this, I guess just to explain this, was because you want some initial distribution of BGT prior to turning on proof of liquidity, or else the surface area for governance-related attacks becomes really, really massive and hard to handle, right? Like someone could build some governance thing, and because they had farmed 100% or a large portion of the initial BGT, they get it out, and then they continue to black hole their validator and just like suck up everything, and it just breaks the chain, right? So that's obviously a bad outcome. So instead, you take a week, You get to a steady state of distribution, then you start taking governance proposals to get proof of liquidity on, and hopefully by kind of like the end of week 2 or so, you start to have third-party gauges rolling out on places like Kodiak and Dolomite and Berachain and others. And the way to kind of think about this, yep, you're 100% correct, right? And so you have that TVL in the BEX pools. This is separate from Kodiak. Kodiak has all their own TVL. This is just on BEX, which is kind of like the chain and stride DEX. You have that pool APR, which kind of ranges very low for stable swaps, as most people expect, up to 25+% for some of these more volatile pairs like W Bear Honey. I'm personally in the W Bear Honey pool. I think if folks are looking at another option that's like less ILE, WBTC W Bear is also really good. And I mean, 28% on PYUSD Honey is fucking insane, right? Like that is a stable swap farm. And it can support size, right? Like there's $69 million of TVL in this pool right now.
And then you can multiply that by the IBGT premium too. So that could even be 40%.
But just to be clear, right? So like if you are deploying here, you will get BGT, not IBGT. So what you need to make sure you're doing is if you want that IBGT premium, you need to make sure that you are deploying it into the vaults page over here on Infrared, right? And so you take your LP token from BEX and then you stake it into Infrared. Super simple.
I don't understand. Why would you have to do that? Couldn't you just mint the BGT that you've earned into IBGT, or is that not possible?
Not possible, right? Because BGT is non-transferable, right? And so there's no way to send it to a minting contract.
Oh, I see. So the only way to get IBGT is through, it's similar. Like you have to farm it. You have to farm
exactly.
IBGT. Or buy
and
it.
that's also why like Dolomite is a really cool unlock within proof of liquidity. Like I've obviously known Corey for a super long time as well, and like he Dolo pilled me on smart margin like ETH Denver 2023 at this point. But one of the really cool things that platform unlocks is you can take your LP token or you can take your asset that's eligible for proof of liquidity and basically just select which of these liquid receipt tokens or into the hub directly that you actually want exposure to once we get that live. And so
this makes so much sense. Like he was explaining this to me like a long time ago, and I was like, yeah, sure, I understand. I had no idea what he was talking about, but now it makes sense. So here you'll be depositing your collateral, and you'll choose, like, say, oh, I want IBGT as my emission. It's trading at a 1.8x premium, which means like you're not going to be getting your BGT. You're literally getting a liquid version of that BGT. It's trading at a premium that you can go stake if you want to, or you could pick any other number of these liquid wrappers, and if you like those better, if you have some sort of preference.
Yep.
For those that maybe are just trying to like find a comparable, I feel like maybe this isn't a one-to-one, but it feels like Infrared is kind of like Convex almost, where you're depositing your LP tokens, you're getting emissions. Those emissions are being given to you in a liquid wrapper, which then have like different functionalities. So it's pretty fascinating. I did notice though that like, Honey obviously is one of the most liquid pairs. I also did see this BYUSD, which is maybe like a ticker that folks are a little bit less familiar with. Do you mind just explaining that to us, Captain Jack?
Yes, sir. So I'll start with the first portion and then I'll get to the second portion. So yes, it's kind of very similar to Convex in practice, with the important difference is that there's no way to actually redeem CVX in this instance for the underlying of like VECRV functionally. And aside from like OTC on the secondary market, versus like in the event that IBGT ever traded at a discount to BGT, they would just turn on the burn mechanism and allow folks to redeem 1-to-1 back to Bera. And so there's like this actual mechanism that should help keep things always at or above peg, which we've kind of seen for CVX and some of the Convex universe assets isn't always the case. You get like a lot more volatility there. BYUSD is a wrapped version of PYUSD from PayPal. And so again, another one of these pretty major stables.
Does that mean that we're going to see potentially like, the ability to onboard through PayPal or Venmo or something like that directly into Berachain? It seems like such an interesting choice. PYUSD is, yes, it's kind of proliferating across Solana and across ETH, but it hasn't quite hit Lindy yet. And there is a lot of speculation that maybe it'll be an interesting new onboarding option for different folks.
Yeah. I don't know that I have the answer to that, and I think even if I did, I probably wouldn't be allowed to share it. But I think the answer is that for Berachain, a lot of folks kind of default to thinking of us as a DeFi chain. I think over the next couple of months, there will be a lot of surprise in terms of like how much work we've actually done on the like consumer adjacent universe. I think that is something that that folks are genuinely going to be like pretty blown away by. You know, I could be wrong, but I think there's some announcements we have coming out that will surprise folks. And I think having the ability to really onboard and meet folks where they are from a consumer-facing universe is really important. And so it's definitely something that we spend time on.
Having
I know
a debit card
Steven's
that can spend honey would be super fun. Anyway, sorry, go ahead, Mara.
No, I know Steven's itching to get into the ecosystem. So just one more question before we get to that. But you said, so for this this epoch or week or whatever it's called, you know, the only 5 places that are getting BGT emissions are these ones that are on BEX, the native DEX to Berachain. You said in the future, hopefully like next week or very soon, you will be onboarding other pools, you know, through kind of different governance props, it sounds like. Can you just like walk us through what that might look like? Or, you know, if this week it's 5, will we be expecting 10 places getting BGT next week? 100, 1,000? Like, how does this kind of like scale out? You know, and like, you know, if people want to advocate, for example, for a pool that maybe they're in or they think that's important or something like that, how can they participate in that?
Yeah, good question. So the way that this will kind of, there's a lot of questions there, so I'm going to try and get to all of them. If I miss any, just remind me. I think the first question is like, at what cadence can you expect this to grow out? I think in the early days, it will be fairly slow. So, right, like maybe week 1, I would expect like 5 or 10 proposals or something like that. And kind of like continuing that cadence for a couple of weeks and then, you know, ramping up over time. In a large part, that's just because governance is going to be figuring their own shit out, right? And so it'll take a little bit of time for them to see kind of like a steady state and get comfortable with everything and be like, okay, like let's expand the scope meaningfully. But at scale, right, like the incentive of BGT holders and of validators is to onboard as many and whitelist as many pools that are non-predatory as possible, right? Like governance's job is first and foremost to nuke predatory pools. But if you think about this from an order book perspective, where every block, a validator proposes a block, and they have to decide which pools they're going to direct emissions to functionally, right? The right way for a validator to do that is actually to basically say, okay, this is the best rate pool, like top of the order book, and then just fully fill that and then move down. And the deeper that order book is, the more ROI you're going to get for your block reward as a validator. And so the validator's incentive is to make that order book as deep as possible. And the way they make that order book as deep as possible is by having as many gauges that are getting bribed as possible. And so I do expect things to ramp up very quickly. And I think for anyone that has a legitimate gauge proposal, or a legitimate rewards vault proposal, I don't see any issues getting those through governance at scale, right? Like the incentives are to basically have them there. What was the other question? Sorry.
No, I think that was great. That kind of definitely answered what I was asking. I guess, you know, there are a lot of folks who are in Boyco, have a lot of funds over there, you know, maybe also want to be participating in all of this, right? Like, you know, want to be earning BGT. Will there be any possibility that not only will we just see like a USDC Honey LP on BEX receiving BGT, but then maybe in future weeks we'll see the like, you know, Kodiak version of this, which maybe some people have deposited into through Boyco or other Boyco related products also potentially receiving BGT or other incentives?
Absolutely, yeah. I actually don't expect any of the BEX pools to get BGT at scale, right? This is solely like a initial thing, because the BEX pools, at least in the current design, don't give out any incentives to validators, right? It flows through back to BGT for the trading fees. And so as a result, like if you have 2 options as a validator, one gets you paid and one doesn't get you paid, you're always going to choose the one that gets you paid. And so these BEX pools are kind of just like an initial way to seed the liquidity and seed the BGT on the chain in a way that's pretty fair, right? Like if you were to choose some random esoteric pool of like 2 third-party niche assets, then that would obviously be extremely opinionated and create a lot of risk for BGT distribution. But you know, if it's mostly on stable swaps and majors and Bera, that's like about as fair launch of an initial BGT distribution as you can create. And then at scale, I think like all of those emissions from validators move to third-party vaults, except for like, you know, maybe there's a handful of validators that are lazy or don't really know what's going on, and they just leave their defaults on and never touch them. Like that might happen too. I think you'd be silly to think that no one's lazy with it.
How are these bribes going to work to validators, right? So like, you know, it's so interesting to think kind of like the game theory that might go into this, right? You have someone like Kodiak, for example, who wants to maybe move incentives away from BEX and move it towards, I don't know, their own, you know, platform, or a money market wants to, you know, like Dolomite wants to compete with a different money market or whatever it is, right? How do you kind of expect that dynamic to play out? Is it going to be in the form of like, you know, do you think like governance tokens in the form of fees? Do you kind of have a general like shape you think that's going in?
Yeah, I think it's going to be all the above. I think governance tokens are and will always be most popular, in that like if you had some planned spend on incentives and you can get improved spend via proof of liquidity, you will. And I think like part of the interesting thing here is like this actually scales really well with project size, right? Like let's imagine I'm a new project launch and I'm trying to figure out how to solve my cold start problem and attract liquidity. If I'm doing this in my governance token that most people have never heard of and don't know, the universe of people you can think of it as like your TAM is really, really small. Versus if you then exchange those for BGT, even potentially at a loss, right? Like let's say I am overpaying 20% in my governance token for BGT, but I attract 10x the TAM. Exactly, right? You actually get really good distribution. Versus then if I'm like a larger application that a lot of people recognize the token for, and there's really deep liquidity for it, and validators demand it, and delegates to validators want it, right? Then, you know, maybe a validator would take 80 cents on the dollar for that, even compared to someone offering them 120 cents on the dollar on the same order book, right? And so there's this like simultaneous game theory there from like an incentivization perspective. There are folks that are going to be using fees. One of the things I pitched at one of our offsites a while back was basically like tokenizing future cash flows, almost like what Index Coop did back in the day. And then basically giving like a receipt token on a monthly basis that entitles the holder to like all of the future cash flows of that application for some period of time, right? And if you can convince a validator that those future cash flows are worth something, right, you can actually basically just like tokenize your company revenues and use those to generate demand for your company now. And validators actually then have an incentive to provide perhaps even more emissions than you're asking for in some capacity, right? Because if they look at like their marginal revenue from like directing one BGT to you versus to someone else, and they have an incentive to drive your revenues up, right? That can actually create an environment where like net there's a good value proposition there for them. And so there's a lot of super cool game theory. And then I also worked on something that we're calling Bark Bulls that I think will actually be getting rolled out. And you can think of that as like a ZK-based OTC framework for validator and application negotiations. And so you're like, look, like I want to incentivize into the market, but I don't know what the rate will be. I wanted to keep that on chain, right, as transparent as possible, but like retain that validator's ability to negotiate effectively with an application instead of just like moving it into a back room or a Telegram channel somewhere. And so, you know, part of the goal there was basically to allow applications to like solicit or like submit indications of interest to validators and then negotiate back and forth between the two to kind of arrive on like a stated rate that they're comfortable with. So that way, when an application, the way it kind of works in practice is an application, when they're submitting a bribe offer, says, I want to give away X number of tokens, and I want to give away X number of tokens at like this ratio of my token per BGT, right? And you implicitly price BGT as Bera, realistically, in the short term. And so, you know, an application might say, look, like I don't know if I should be pricing this at 80 cents on the dollar or 90 cents on the dollar or what the right number is. And so if you kind of like are able to have these OTC conversations in a pretty transparent way, you can help figure out like what the accurate willingness to pay is for a validator for your token, and then actually get like most efficient pricing set up as well.
Everything in DeFi is moving to Dutch auction style. You just gotta do Dutch auctions everywhere all the time.
Yeah,
so
indeed.
I know we don't have a ton of time left, but there's like so much to think about conceptually. I do want to like go back real quick and look at that. Oh my gosh, so many links up. the vaults here on IBGT, like these yields are phenomenal. I'm wondering if you know, like they have Dolomite here, Kodiak here listed as vaults you can already deposit into. Does that mean that these are already whitelisted for BGT emissions like next week, or no?
No, so these were the Infrared X Kodiak, Infrared X Dolomite Boyco deposits.
Got it.
And so the idea here is down the line, you'll notice, I think all of these vaults, or the vast majority of these vaults, are major vaults in some capacity. And so the idea was like these would be the most likely markets on Kodiak and Dolomite to get whitelisted. And the problem, or not the problem, one of the design limitations of Boyco is that because it's fully non-custodial, the deposits are custodied in this Wayroll wallet, and the lock is enforced at the wallet level. And so, like, let's say a user wanted to then stake that into Infrared, they're actually not the custodian of the asset, right? Like this wallet that has a lock enforced is. And so there's actually no way to then take that if it's not already staked and put it into and stake it into like a liquid staking platform like Infrared. And so basically what we did is we pre-staked all of these into vaults, knowing that if there were rewards vaults on them down the line, those would immediately start flowing yield.
Got it. Okay, so that, going back to Mara's question, just want to make sure that we're crystal clear on this. If these do end up getting BGT emissions, those BGT emissions will get passed on to the vault and therefore the like Boyco participant.
Yes.
Amazing. Love it. Fantastic. Okay. So there are so many protocols. I mean, I'm so glad that you went over like the theoretical sort of level and incentive mechanisms and sort of the way that Berachain is going to work. I think that's probably what the fundamental analysts want to hear and are curious about, and you know, gives the value case for the chain as well as the asset. Me, I'm a yield monkey, right? I'm just hopping around looking for numbers. So I see them here. I am already excited about Infrared. This is obviously really cool. Farming IBGT is awesome. Even being able to stake IBGT for some yield and maybe kind of trying to hedge that for some delta neutrality could be a lot of fun. But there's a lot of other stuff happening. We can't talk about Goldilocks because that would take literally an entire other hour. I am excited for this. I hope they launch the vault soon. It seems like a Pendle-like for those who don't know. It's also doing a whole bunch of other stuff, like literally being able to launch a token that's going to have an NAV, which is sort of unheard of. Imagine like Pump.Fun, but there's an NAV for some of these memes. I'm not saying this is like that, but it's going to be cool. And then there's also a bunch of other super major protocols coming to Berachain. I mean, we're going to see Pendle. We already see Bolamite or Dolomite. I'm just wondering and then just like being able to leverage some of these crazy high yields. So you have IBGT as a liquid asset. Imagine borrowing Bera against that and then like looping that. Not only is it a premium play, but it could also be like question. Is there a liquid staked version of IBGT? Like as IBGT or something like that?
No, so the problem with that, the answer is no. I think there will be down the line. The short-term kind of like trickiness there is that your IBGT rate will actually be variable on like a per validator basis, right? And like if you think about it from Lido, like Lido spreads stake across all of their different validators, but your yield from IBGT will actually be really, really dependent on exactly who your validator chooses to push their block rewards to. And so I think over time you get to a situation where Infred's working on this thing called Bribe Boost, which is basically like a way for validators to automate their allocations to be like kind of optimal based off of the current order book. You know, I think you can take a set of validators that's all running a consistent Bribe Boost and then aggregate that into an LST. But I think in the short term, yeah, it's just like a little messy given it's really hard to know kind of like where your yield will end up on a per basis. I know a lot of folks are like thinking about this 10% top line inflation number. That's going to come down, right? And the goal is to get it down to like a kind of a steady state where the base reward that validators are getting is kind of perfectly matches their operational overheads for running a validator. And then validator profitability is determined by their interactions with users via securing BGT delegation and via applications, right? Via this exchange of block rewards. That is really, really important from kind of like a philosophical point of view to us, because one of the things we consistently see in basically every L1 eco is that there's no method of normalizing validator value capture across actual execution side demand, right? validators get paid the same amount regardless of if the application universe is crushing it and they have a ton of users, or if like no one gives a single shit about the chain, right? That's like deeply problematic in our eyes. And so like this is one of the core goals of proof of liquidity. The second thing is we should see BGT rate growing slightly above the net inflation rate. And so if I think about this for my fundamentals guys, from like a balance sheet perspective, your top line would be the incentive / bribe amount coming in. The costs would effectively be the inflation to the network. And then your bottom line is basically like, did you grow your bribes at a greater rate than inflation picked up, right? And as a result there, you can actually get to like what I would consider to be like hyper air quotes profitability here, in that the chain is creating more value for its stakers via demand for applications from users than it is diluting stakers in the form of inflation, or diluting users in the form of inflation, right? And I think that's really, it was like the entire thesis behind ultrasound money back in the day that a lot of people on the east side identified with. The problem with ultrasound money was that it came at odds with the chain because all of these functionalities were bundled into a single asset, right? Which created a lot of overhead. And by separating out those roles and responsibilities and then adding in, a chain with single slot finality on the back end, ETH execution finds on the front end, and modularity in that design down the line, we actually have like a path to upgradability, both like following the EVM as well as like improving throughput from like a consensus or database or whatever else perspective over time. Absolutely, yeah. I would say like for us, the areas we spend the most time for sure are like DeFi and consumer applications. I think there's also like a really funny thing that I spent a lot of time on, which is that like in a large capacity, I think like proof of liquidity can actually help fix L2 value demand. And because we're fully EVM identical, it actually means like Arbitrum orbit chains just like work out of the box on Berachain. And so like if you think about like part of the difficulty with L2 designs, it's like how do you actually return value back to the L1 while also keeping value at the L2 level? A lot of folks try and justify this through like having some random niche gas token as the gas token of the chain. But you can do something like, this is the super simplistic version, right? I set USDC or Honey as my chain gas token because that's accessible and eases onboarding. I earn native yield on that L2 gas token on the L1. I have a rewards vault for my company token paired against a stable or Bera on the L1. And then I use a portion of that native yield or my sequencer revenue or whatever else it is to incentivize that pool. And now the L1 is happy because there's liquidity on it. You can get a bunch of DeFi integrations so that way you don't have to onboard every single DeFi application to the L2 to create liquidity sinks for your token. Users get a better experience on the L2 because they're using a token that they actually have in their wallet already and not some like random governance token. And you can still keep all of your sequencer revenue if you want to, right? And so you kind of can make everyone happy in some capacity here.
My head is full. I'm appreciative of all of that. Personally, I'm probably going to go farm on Kodiak just because I was looking at the metrics. By the way, guys, if you don't know how to look at the metrics on Kodiak, if you go to like V3 pools, click top V3 pools, this will require a bit of math, but I promise you, if you do math, you make better yields. So learn how to do math. Just looking at some of these, like with Honey, 30 bips, right? No, sorry, not this one. Where is it at? 30 bips here. There's $1.65 million of TVL. There's $2.66 million of volume. You take a third of that, annualize it, and you're going to have a good time. You're going to be in the hundreds of percents there. So all I'm saying is there's yields here. The fundamentals, I think, are sound. Go ahead and give this like a re-listen. Make sure you understand what's going on here. I really think that like the liquid versions of BGT are interesting, but also BGT as an incentivization structure should pique your interest. This is something entirely novel, but it harkens back to some of the stuff that we're already familiar with that has worked in the past. So I'm not saying like go max long Bera, but what I am saying is I think the vast majority of retail has no idea what's going on yet, and once they slowly come around to realize, Berachain will probably get a very large second win. So thank you so much, Captain Jack Barrow, for joining us, and everyone else, have a wonderful rest of your day.
Thank you guys.